Hey everyone, welcome back to this YouTube channel. Today we'll be doing a recap of the fundamentals that happened this week. I'm going to break down what happened, why it happened, and where I think EURUSD is heading fundamentally speaking, and why. So right off the bat, for those of you that tuned in last week, I told you that we were waiting for CPI. So that's going to be the big news, and I'm going to talk about how it affects everything. For those of you that are new to this channel, hit that subscribe button. We're planning on doing these weekly. For me personally, fundamentals and technicals are 50-50. So it's very important to understand fundamentals as it is what the banks are trading. So right off the bat, I want to mention CPI. CPI came in higher than expected. So this means a couple of things. The first thing I want to mention is this is actually higher inflation. It's one of the tools the Fed looks at. It's one of the economical indicators, I should say, that the Fed looks at to see how the economy is doing and when they can begin rate cuts. Now, initially in December, speculation was that rate cuts could come as soon as March. I believe this number coming in at 3.4% instead of 3.2% is signaling to us that even if rate cuts happen, they will likely happen later than March, and the sentiment right now is the earliest rate cuts possible is likely around May. So let's actually dive into it and see what happened. So first off, I want to show you guys, this was CPI. Now, many assume that price should just continue down on the strength of the US dollar. So you're probably asking, why didn't price continue? And we're going to talk about that, and I'm going to explain it to you. So let's do a weekly recap of what actually happened. First off, CPI came in higher. So this means inflation's higher, which is bad for the consumer, but it's good for the currency. It basically means the dollar's devalued, so the US is technically in less debt than they actually are if the dollar itself is devalued. So while it's good for the dollar, it's bad for the people. It's kind of a weird one to think about. The initial jobless claims came in lower than the forecast. If the interest hike policies are working, what we should be seeing is a declining CPI, and the jobless claims should actually be going up. It's kind of it's a bit of an oxymoron, but to fix the economy, Powell essentially has to force companies to lay more people off. So unfortunately, that's part of fixing the economy. So with this in mind, there's a few things that happened here that I want to cover. And I just want to make sure I'm showing you guys the right article. It might actually be this one. Okay. So same thing, basically the same article from different people. What we want to talk about is basically what happened. And this is why the CPI didn't have the effect people thought it would. So I'm just going to read this out and then I'll explain it. So initially, this led to a rise in the US dollar and bond yields. However, the bullishness was short-lived as the 2-year US Treasury yield fell 11 basis points to 4.25 and the 10-year slumped 6 basis points to 3.97. So this almost counteracted what actually happened on the chart. The timing happened right around here. So for those of you that are wondering why didn't this continue down if the CPI came out higher than expected, that is why. So that's the first thing that happened. This is part of our macros, and basically we knew that this is going to tell us a couple of things. One was how soon are the rate cuts coming, and how's the market responding to it. The market is not buying the dollar's bullishness due to those yields that I just showed you guys. There's another thing that's going on here, and on Friday, the PPI came out worse than expected. So the PPI is the producer's index, whereas CPI is the consumer's index. So let's go look at that now. PPI is basically companies like Walmart, Target, whoever. And if you actually look at what this means, the demand fell for goods. Basically, the demand for goods decreased, meaning the producers are not doing as good. Essentially, this is an inflation measurement index for producers, whereas CPI is the measurement for consumers. When it comes to the Fed, they care about the CPI more than the PPI. NFP and CPI essentially is telling them how well the economy is doing. If the rate hikes are working, there should be more unemployed people, and there should be lower inflation for the consumers. So this may just be a delayed effect that's coming. So as of right now, the expectations for the rate cuts are delayed by likely a month or two. Obviously, the next month CPI data may change this. Now, there's something else that happened on this weekend. This week I should say. And that was the conflict with the US and Yemen beginning. Now, let me see if I can find the right here. So here they talk about the crude oil prices basically going up because of the airstrikes against the Yemen rebels. This could actually change the strength of the dollar once again, depending how intense US's involvement gets. So if US gets more involved in this war, this will likely drive oil up, this would drive gold up, and this would give the US dollar some strength. However, that all depends on the size of the war and the intensity. The other thing that happened is the Saudis are actually willing to cut oil prices, which they can afford to do because their oil is way cheaper to produce than anyone else in the world. So the Saudi oil can be refined at $7 to $10 a barrel, whereas like Canadian oil is anywhere from $20 to $40 a barrel, and US is $20 to $60 a barrel for refinement. If you talk about US's shale oil drilling, because of the constant relief wells that need to be drilled, US oil is very expensive to drill. The Saudis, on the other hand, can undercut everybody and lower oil price to basically sell more oil. So this, depending how much oil the Saudis could flood the oil market with, this, again, could change the price of oil for those of you that trade oil. I don't personally follow it too closely. It just caught my eye, and I'm not sure actually where I've seen it. Anyway, the long story short here is what caused this spike in oil price and what the market is actually looking at sentiment-wise. So this all came from these airstrikes and stuff. So now let's talk about a couple of other things I wanted to mention, and I wanted to show you the institutional positions and where we're heading that way. This is a really good tool, Prime Market Terminal, probably the best tool there is available to Forex traders. So let's just go look at EURUSD. Now, there's a couple other things I want to mention. So as of Friday, institutional positions once again haven't really changed much. So you can see the euro longs, the euro futures are quite a bit higher than the US futures. We do have a slight uptick in the US futures from last week. I don't think this is anything to worry about. The number's really not significant. So right now we're net long on Euro USD long term. The question is when are we going to start trending again? This could take a little bit. It could take more fundamentals to truly move the market. That's yet to be seen. Now, there is one other thing I wanted to show you guys. And this is a bank report. So this bank report includes a couple of the members that sit on the Fed board. And this is kind of what they're talking about here. So we have two hawkish voters. They talk about Thomas Barkin and Loretta Mester. And they're both hawkish I'm saying 2024. Hawkish means it's a bullish sentiment for the dollar. Now, what they're saying here is March was too early for a rate cut. So as of December, the market was pricing in 5 rate cuts this year of a quarter point each time. Right now, from what I read from all these articles, they're now saying it might only be 3 rate cuts instead of 5. And March is likely too early. And May is a more likely time to cut. So if you read what Barkin said here, they're still waiting for this 2% inflation to be hit. Now, if we look at CPI, we've come down, but it's not enough. We're still not at that 2% mark, and I think we're going to have to inch closer to that 2% mark, and the unemployment's going to have to go down more before we actually see a true commitment of these rate cuts. I don't think there's anything else too important here. Everybody's talking about the oil prices being higher due to the US and the UK military strikes against the rebels. This is something we have to keep an eye on to see how involved US gets, to see the size of this war. This could be something that becomes huge in the fundamental bias, or it doesn't get any bigger and it doesn't escalate and it doesn't affect things in the grand scheme of things. So this is definitely something that we have to wait on. I will keep you guys in the loop as I read these bank reports and see what's released to us. And aside from that, I believe we're all caught up. There might be one other thing I missed. Let's see, CPI, PPI, BOE. Yeah, the CPI and PPI. So they kind of counteracted each other. So this is CPI, this is PPI. You can see how they kind of went against each other, and you can see the data here. Obviously, this came out worse than expected for the States. This came out better than expected for the States. However, the yield pricing that day basically stopped this dead in its tracks. So right now, my overall sentiment is neutral / bullish for US Euro USD. The reason I'm saying neutral / bullish, you can see we are in CMC. This is consolidating market conditions. Essentially, price is moving sideways. We'll have to see what it does next week. See if these lows hold, see if price wants to continue up or down. My expectation would be more consolidating market conditions before the market truly moves. If I had to pick a side, I would still be more bullish than bearish. This could mean price takes off like that. This could mean price does that. Anything like this is possible, obviously depending on macros and technicals. Well, that being said, the only thing we are certain of is the direction will be up. It's just a matter of when. Now, December didn't consolidate much, so there is a chance that January could consolidate quite a bit. Usually both December and January consolidate. You can see December pretty much trended. So if that's the case, we could see more consolidation for longer. Now, let's just take a look at what we have next week. The next things that are really going to affect us huge is the interest rates for Euro and for USD. So all of this stuff next week is pretty minor. None of this stuff is really going to shift the market too much. Euro, Bank of Canada, that won't really affect us too much. So at the end of January, Euro main refinancing rate. So this will be kind of, this and the job reports here will be kind of the next time where something comes out that truly impacts us. And obviously the PMI for all of Europe. So the following week here, nothing too crucial is really happening that will likely get us moving. This week could, the following week could, depending what the main financing rate for Euro is going to do. I'm going to assume as of right now they're going to hold, but we'll see. And at the end of the month, we have the FOMC federal funds rate. The sentiment right now is they're going to hold, but I'm expecting one of those to be the catalyst to get us moving. Obviously, we don't want to predict the market. We want to react. This week is big for us because we have FOMC and we have NFP all in 1 week. So I would assume this would be the week that'll truly get us moving. We may be fortunate and it may start moving before that, but as of right now, yeah, we're neutral and we're bullish, and we will play the market as it comes out. So I hope you guys all enjoyed this video. I plan on making another one next week where we will continue to do weekly recaps of everything that's going on and anything that I see Euro USD, so that you could better prepare for the week and understand where the fundamentals are heading. Because we got to remember, banks hire people with economical degrees that understand fundamentals. So with that in mind, we know that it is very important to understand fundamentals. You can also see our news sentiment here for the last week. It's pretty neutral. We're not really doing anything. Whereas in December or November, like, you could see the differences in the bullishness. So we're essentially waiting for these scores to start outweighing the positives to negatives quite a bit, and the greens basically to start spiking up. Once that happens, that means we're more fundamentally bullish than we are bearish. Right now, we're a tiny bit more bullish, but not enough to get us moving. Whereas when we start moving, you'll start seeing green bars like this. And that just means more and more fundamentals and market sentiments are coming out bullish for Euro USD. So again, our macros matter. This Yemen war thing, depending what happens with it, will matter. And obviously, yeah, that's about it, guys. So yeah, for those of you that stayed and finished the video, congratulations, proud of you. I will see you guys next week. Have a great rest of your day.